tell you about our special series, Hello GST. CNBC TV 18's Menaka Doshi has been decoding the benefits of GST for a whole host of sectors, and today she takes a look at the real estate sector.
On Hello GST, today we analyze the impact of GST on the real estate sector.
I would say the real estate in general, the impact is not going to be very positive. The cost would go up, at least in the short run, even if we presume a rate of 18% of GST. The real issue is about keeping the land outside the value when we talk of, say, sale of a flat or a unit, and the states being allowed to levy stamp duty on such transactions, effectively saying that the states are at a free will to increase the stamp duty rates whenever they want if they are falling short of their targets. If you see from a consumer's perspective, it clearly means that he will continue to pay stamp duty, probably at a higher rate, and also the GST at an increased rate on the value of the goods and services. The other larger issue that one can see is that under the current indirect tax regime, no credit on inputs or the goods which are used, the services which are consumed, are allowed to someone who is constructing a factory or office building. Take the case of a manufacturer or a service provider. It is said that the same position will continue under the GST regime. If this is the case, it effectively means that the real estate is actually kept out of the GST net, and this would mean a large cost for the industry because the taxes are not fungible.
Assuming a standard rate of 18%, how much more expensive will it get, Sagar, for, let's say, a manufacturer setting up a plant or even a home buyer buying a home?
So if I look at a home buyer, I will say that even if you presume that about 70% is the value of goods and services as the land which is there, which is the balance 30%, if we just take a proportion and compare the current rates to the rates under GST, I will presume that it will still be about 11 to 12% effective rate that will be there on the entire flat value, in addition to the stamp duty. So if you look at states like Maharashtra or Karnataka, which is about 6%, the composite rate will be about 18% or even more than that. So that's going to be pretty high. If you take a manufacturer, I would say that again the entire cost which he was earlier paying as a service tax or the excise duty or the VAT will continue to become his cost because he is not going to get a set off. From the current tax to the new tax that is under GST, the increase in rate is going to affect him directly. So this means that effective rate, if it is about 12%, it will go to 18%. It will still mean an increase in cost to him to such an extent.